Good afternoon, everyone. This is Bill Passarodi again from Palmer & K Insurance. We appreciate you all joining the webinar. We still have a few folks trickling in, but we're going to go ahead and get started out of respect for your time. On behalf of Palmer & K and Jack Kay, our CEO, we really appreciate you taking the time out of your hectic and busy schedules to join this webinar. We are obviously very humbled by some of the conditions taking place across the United States due to COVID-19. We thought that this presentation was timely to our prospects, clients, and centers of influence so that you can have an opportunity to receive some very pertinent and relevant economic updates. We are pleased to have one of the chief economists for COFAS Trade Credit Insurance on the line, Mr. Ruben Nizard. Ruben will share some very timely and yet light commentary on the economy as COFAS sees it. Some of this is obviously going to be specific to the impact that COVID-19 is forecasted and is currently placing on our clients. After that, Ryan Morse, also from COFAS, is going to introduce the topic of trade credit insurance as an option for those business owners that have heavy accounts receivable to consider protecting the financial interests of the firm. So without further ado, I will run through some quick logistics. We are going to ask you all to hold questions until the end of the economic impact. We will field questions through the private chat, and then Ruben will gladly answer those at the end of his segment. And at the conclusion of Ryan's piece on trade credit, we'll also follow up with questions specific to his. So again, on behalf of Palmer & K, we appreciate it. And Ruben, I am going to turn it over to you at this time.
Good afternoon, everyone. Hello. I hope you are all safe and well. Thank you for joining us this afternoon for this presentation on and this economic update on COVID-19 and its impact for the world economy and North America. So I do hope that you're all able to see my slides from now. So as the year started, COFAS and the Economic Research Department had warned that the main risks to the global economy in 2020 will be of non-economic nature. When we announced that, we were thinking in particular that political risks with the trade war was one of the main threats to the global economy. But if we were right to assess that the shock to the economy would come from a non-economic source, we were wrong, and we didn't see, like many other, that the shock would come from a health and sanitary crisis. So here on this slide, you can see basically our baseline scenario for how the sanitary situation is going to evolve, because what is really important to understand is that this crisis and the impact of this crisis, of this economic crisis, is very contingent on the evolution of the pandemic. That's also why there is more than usual a lot of uncertainty surrounding forecasts and the outlook for the economy. So this crisis started in Q1 with COVID-19 that started in China. And it started in China and started to impact some supply chains that were linked to the Wuhan and Hubei region. And especially in the automotive sector, we were seeing this impact starting to affect the global economy. But as the virus spread, we've seen the lockdowns start in Europe, in the US, and in all other countries of the world. And by the end of Q1, we had more than half of the world population being forced to stay at home. So with this crisis of unprecedented nature, it means that the entire economy is put on hold, and economy comes to a standstill. So it's a very deep and rapid impact. And that's why this crisis is very different from any recession that we've seen in modern history and any crisis that we've seen at least since the post-war era. So going through our scenario, back in March, we had put forward that the lockdown would start easing by the end of April, early May. And then the economies around the world will start to gradually reopen. And that's what we're currently seeing with many countries in Europe that have started to reopen their economies. So for instance, Germany had started last week. France has started to reopen schools yesterday. And in North America, particularly in the US, some stay-at-home orders that have been issued in the second half of March. So, but what we can currently see is that the easing of the restrictions of movement is very gradual. And that's very important to note, because what we expect and in the months to come is that this reopening process will go on, and that we won't be returning to the pre-COVID-19 crisis level of activity before a long time, and that the road of recovery will be quite long. So this is our baseline scenario, and our risk scenario is if we would see a second wave of the pandemic, either in Asia or somewhere else in the Western Hemisphere. So that's what we're currently focusing on, and what we will be monitoring in the months to come. So on the right-hand side chart of this slide, you can already see the first impact of the COVID-19 crisis. With the economy at a standstill for about 2 weeks in the US, you can already see that GDP, so gross domestic product, in the first quarter of 2020 declined by 4.8%. That was the sharpest decline in GDP since Q4 2008. And it was only with about 2 weeks of lockdowns. So you can easily imagine that the impact in the second quarter of 2020 will probably be even sharper. And we are currently forecasting that the US economy will contract by at least 20% on a quarter-on-quarter annualized basis in the second quarter of 2020. That would be unprecedented in the US history, and demonstrate how this crisis is different from any other. But what we're seeing in the US is quite common to what we're seeing in all of the world. So what you can see here on the left-hand side chart is our GDP estimates and forecasts for world GDP. As you can see, we're expecting the sharpest downturn since the Great Recession, and we're expecting GDP to contract the GDP for the first time to contract in 2020. That would be the first time since 2009 and the great financial crisis. So what is really important to note is that these forecasts are the ones that we made in late March. So we are currently revising our forecast. And as you would expect, we are mostly revising our forecasts downwards. But even when looking at individual forecasts and comparing these GDP forecasts to the 2009 outturn and the 2019 estimates, we can already see that in most advanced economies, we are expecting this crisis and the contraction in GDP to be the deepest in history, even sharper than the 2009 recessions in most countries. So that's the case in Italy, where we expect growth to contract by more than 8%. In France, where we expect it will contract by close to 7%, and also in the US and Canada, where we respectively expect GDP to contract this year by 2.9% and 3.5%. So that would be for both countries the worst GDP outturn since we have figures for GDP. And so mostly since the end of World War II. So this very low level of activity and this contraction in activity will translate into broad-based and double-digit increase in bankruptcies that will impact businesses all over the world. So you can see from this chart with our forecast for business insolvencies globally that we expect at the global level that bankruptcies will rise by more than 25%. And what is also very clear is that this rise in business insolvency will be driven by the US and North America. You can see that we are currently forecasting more than 39% increase in bankruptcies in the US. Even though lower in other countries, the rise in bankruptcies is at par with what we've seen during the Great Recession in 2008-2009, with bankruptcies, a wave of bankruptcies expected in most of advanced economies. So these forecasts are again all March forecasts, and they will probably be revised downwards going further in the future. But before going into why we're seeing this rise in bankruptcy, I just want to show you a little bit of what we've seen in bankruptcies so far this year. You can see that the momentum in the US economy before COVID-19 was already losing steam in terms of business bankruptcy filings. You can see that in 2019, for the first time since 2009, business bankruptcies had risen. So it was a modest increase of about 2.3%, as you can see with most of business bankruptcies in the second and third quarter. And what you can also see is that the first quarter of 2020 was also, we've seen a rise in business bankruptcy filings. But actually, this rise, you can see, is not yet the wave of bankruptcy that we're expecting, where the rise in Q1 was about 6%. So we're still far off from the 39% that we were expecting. You can see from the right-hand side chart that when looking at business bankruptcy filings by chapter, even though Chapter 11, bankruptcy filings to reorganize debt were on the rise in March, you can see that liquidations with Chapter 7 bankruptcy filings were down in March, and that overall in March there was no big increase in business bankruptcy filings. So we haven't seen yet the impact of COVID-19 on bankruptcy filings, and the increase that we've seen in Q1 is more a result of the loss of momentum of growth that we've seen since the second half of 2018, notably because of trade war and the slowdown in the manufacturing sector, rather than because of the COVID-19. But there's actually, and we have no doubt that we will see a wave of bankruptcy coming in at the end of Q2 and in Q3, because, well, debt levels are at record high levels in North America, and especially short-term liabilities are at record high levels, which says that many companies are likely to be forced to file for bankruptcies in the future. But why will they file for bankruptcy? Well, the answer is threefold for us. We think there are three main reasons for this increase in bankruptcy. It's because the economy is facing three simultaneous shocks. So the first of these shocks is the supply side shock. So as I mentioned, this crisis started in China. And as you know, China is central and plays a pivotal role in global supply chains, especially for North America and the US. So you can see here with this survey conducted by the Institute for Supply Management that many companies reported supply chain disruptions as early as late February, even before the epidemic started in most of the Western world, because of supply chain of plants closure in China. And as the pandemic expanded and reached new parts of the globe, and that's what you can see on the right-hand side chart, well, these supply chain issues started to spread globally. And you can see now that respondents and companies were reporting longer lead times, not only in China, but more than 3/4 of them were also reporting longer lead times in Europe. In North America, you can see that there were, at the end of March, about 40% of companies that were already experiencing longer lead times, and this share would probably increase through April as more and more businesses and plants have closed. So with longer lead times, it leads to longer average lead times, and you can see that typically lead times, so the entire process along the supply chain, has more than doubled in time, including for domestically sourced products and inputs. Having said that, once we have seen these supply chain disruption, what is really important is to look at the level of inventories to know if companies are able to cope with these disruptions in the supply chain. And typically what we see in advanced economy and in the US is an average of inventories covering about 1 month of sales. So that's not a lot, but considering that we have lower demand because of the COVID-19 shock and crisis, well, these months of inventories should allow most companies to face these supply chain disruptions. Nonetheless, some sectors will face stress on their supply chains. So it will be the case for some segments in the agri-food sector where the demand has remained high, and we know that inventory levels cannot be kept at cannot keep high inventories for perishable goods. So that's one of the sectors we see in stress. The pharmaceutical industry, where we have very integrated and global supply chains, might also, and where we typically have lower inventories to sales ratio, is also one of the sectors we highlight as being at risks. Two other sectors that are particularly at risks and that we will probably see the supply chains having more of an impact once the economy starts recovering and starts reopening, it's in the automotive sector and in the textile clothing industry, where inventory levels are also very low. Also, it is worth noting that in the US, the semiconductors segment is very exposed to supply chain disruptions. But my guess is that we shouldn't see so much supply chain disruptions because these supply chains are very dependent on China, which has already started to recover more meaningfully, having experienced this crisis earlier. But as I mentioned, these inventory levels should be enough to cope with the crisis because the economy is facing a second shock, and it's a demand shock. As the economy came to were put in lockdown, and as people were forced to stay at home, people had to adjust their behavior, and people were no longer able to spend and had to put their money into savings. So you can see from this left-hand side chart how American households had already started in March to adjust their behaviors to the new situation of the COVID-19 crisis, to the new situation of the COVID-19 crisis. You wouldn't be surprised that most of American households have canceled or changed their travel plans. Many of them have put off large purchase because of uncertainty, surrounding the outlook for their financial situation. with most people avoiding public places, well, you can easily imagine that starting to avoid public places even before retail stores started to close meant that already we were seeing an impact on demand and on people's ability to spend. And it translated into the March figures for personal consumption expenditure. You can see that in March, personal consumption expenditure declined on average by 7.3% compared to February. And it was mainly driven, it's interesting to note, to look at it segment by segment and by type of spending, is that this decline has been led by durable goods sales. So what are durable goods? It's goods that people that are meant to last more than 3 years. So it ranges from a toaster and it can also be a car. So things that you would typically keep for more than 3 years. And it's not a surprise that when people started to be worried for their food security and having access to just the essentials, they would stop spending on these durable goods that are non-essentials. So it's also interesting to note that the non-durable goods, discretionary spendings also went down quite meaningfully, and you can see that with the clothing and footwear segment, where people were spending from American households in clothing and footwear declined by close to 30%. So it shows how the shutdown had started to impact the economy, and that's why on the GDP contribution figures for GDP, you can see that household consumption, which is the backbone of the American economy, is the main driver of the decline in GDP in Q1, and will probably be the main driver of the decline in GDP in the second quarter. But we can expect this demand shock to be sticky and to continue having an impact on the US and Canadian economy over the next months. Because as you can see, with the economy put on hold, well, companies and businesses had to conduct massive layoffs. You can see that here the unemployment rates in the past 50 years, and you can see that both in the US and Canada, the unemployment rates reached record high in the past 50 years. So it was massive layoffs being conducted in the transport industry, in the hospitality and leisure sector, in the retail sector, in the restaurant sector as well, that is having an impact on that is leading to massive losses in jobs. So just in the US, in April, more than 20 million jobs were lost. So that's unprecedented in the entire history. The 14.7% unemployment rate is also the highest since 1940, and when the economy was still recovering from the Great Depression of the 1930s. So it shows how rapid and severe the COVID-19 shock is. And it's worrying for the recovery because it means that disposable income for households is going to be impacted for the months to come, and it's probably going to translate into a slow recovery in the months to come. You can already see with this chart on the right-hand side that disposable personal income had started to fall in March by 2%. And with it, consumer confidence has started to plummet. And we can expect these effects are usually sticky and will continue to impact the US economy in the months to come, even though it will start reopening. So having said that, what sectors are going to be most impacted? And it's important to mention what sectors are going to be most impacted. This crisis is very specific and unprecedented. And it means that, and it's also unprecedented because it spares almost no sectors in the global economy. But some of them are more exposed than others. And that's, for instance, the case for the transport industry, and particularly so for the airline and air transport industry. You can see with this left-hand side chart that passengers going through checkpoints in 2020 was less than 10% over the past 10 months, over the past 2 months, sorry. And we can expect that lower travelers numbers in the months to come, because airlines will struggle to recover full capacity before 18 months. So that's one of the worst hit sectors. Another of the sector that will have to bear the brunt of this crisis is the retail sector. As I mentioned, disposable personal income will be affected by the lower level of unemployment rate that will probably remain at higher level than before the crisis broke out. And it will probably mean that the downturn in retail sales is probably going to affect the industry in the months to come. And the industry was already in a fragile position before the crisis broke out, with many retailers that had piled up some debt in the past decade after the great financial crisis, and retailers struggling with the rise of e-commerce and changing consumers' behavior. So that's why we probably see retail being one of the drivers of the increase in bankruptcies. But another driver of this increase in business bankruptcies will also be the third shock, the shock on commodity prices. So this shock on commodity prices is more a consequence of the dual shock that we're seeing on the supply and demand side. And it's mostly affecting emerging economies. But the US and Canada are also very much exposed to this shock on commodities prices, and more specifically on the shock on oil prices. You can see with this chart on with the number of rigs drillings for oil in the US, the period of boom and bust of the US energy sector in the past decade. So you can see after the great financial crisis, how production started to increase thanks to the shale revolution. You can see how it plummeted, the sector plummeted between 2014 and 2016 as WTI prices and oil prices plummeted during this period. You can also see the recovery in 2017 and 2018 that had propelled the US at the rank of leading crude oil producer, producing more than 13 million barrels of crude oil every day, or 13% of global supply. And you can also see how fast companies were forced to react to the downturn in crude oil prices that we've seen in recent weeks. You can already see that the numbers of rigs drilling for oil fell to a lower level than in 2016. And this is a result of companies have to cut rigs drilling because with prices at this low level, they are not able to break even, and with a high level of debt in the sector, they are particularly exposed to a rise in bankruptcy. And that's what you can see on the right-hand side chart. Already in 2019, we were seeing that the sector was losing momentum because the high level of debt were already forcing the most vulnerable actors in the energy sector to file for bankruptcy. We were expecting that in 2020, the oil sector will probably see another rise in bankruptcy, and especially in the upstream sector and oil services firm filing more and more for bankruptcies. But with this crisis, we can see that we can expect that up to, and that's the purple line, we can expect up to 400 bankruptcies just in the upstream sector. So there is no doubt that the oil patch would be one of the drivers of the rise in bankruptcy, of the sharp rise in bankruptcy that we see in the US and Canada for the months to come. And it's going to have an impact on other sectors in the future, including the metal sectors, with, for instance, steel producer that will have lower demands for steel that will be used in pipeline. One of the silver lining of this crisis is that in the face of this unprecedented shock, we are also seeing unprecedented policy response. So it's both an unprecedented response on the fiscal policy, and that's what you can see on the left-hand side chart with the detail of the CARES Act. So that's the bill that was passed about a month ago by Congress, worth approximately 2.2 trillion US dollars. So these package and this relief package include expanded unemployment benefits. It includes also small business loans and grants, including the Paycheck Protection Program that aims at keeping a lot of workers and most workers on the payroll to avoid a sharper rise in unemployment. And it also includes loans and grants to airlines and more specific support to hospitals and the healthcare system. Another relief package was passed 2 weeks ago, notably to have more funding for the small business loans and grants programs. And yesterday, the House, the Democrats in the House of Representatives presented a new relief package worth $3 trillion US dollars. So we'll see where this new relief package goes. But already with the CARES Act and subsequent measures worth about $3 trillion US dollars in total, or 14% of GDP. So that's that of the US GDP. It's also equivalent to approximately the GDP of France. So the seventh world economy. It's unprecedented, and it will help the economy cushion the impact of the shutdowns, and more importantly, will help companies to recover. We are also seeing unprecedented policy response from the monetary policy side, and especially the Federal Reserve is doing a lot to ensure that there's enough credit flowing through the economy by expanding the quantitative easing program, so asset purchases program, to make sure that companies have enough liquidity. It is also going to support businesses with more direct lending programs, so the Main Street lending program that will be rolled out in the weeks to come, and we will see how it works. And hopefully it will help companies to keep a lifeline in these difficult times and to recover more meaningfully into 2020 and 2021. So this is with these more positive message that I would like to end this first part of the presentation. We can move on to the Q&A session if there are any.
Ruben, this is Bill. We do have 2 questions coming from the audience. I will give you the first one and allow you to respond to that before moving on to the second. The first question is, if we call this, there's been much talk in the marketplace, by scientists and the administration that there could be a second pandemic, if you will, kind of a second outbreak. If there was to be such a second outbreak, have you forecast for what that, quote unquote, from the questioner's own words, what that doomsday scenario would look like?
So we are currently working on these scenarios and on this risk scenario. And basically some of the results is that the contraction in gross domestic product in the US would exceed 10%. So it means that close to more than a tenth of the output will be wiped out if we were in such a scenario. So that would be devastating. And more importantly, I do think that the longer a crisis lasts, the more economic damage it leaves behind. So with this current crisis, even though it's very severe and very fast, and it's a very deep recession already, we can hope that in 12 to 18 months, and if we have a vaccine and a treatment, that in 12 to 18 months, things will be back to normal. But if we were to be in a double dip scenario, well, we would probably have to deal with the legacy of the COVID-19 crisis for longer. So that's also one of the main worries.
Thank you, Ruben. The second question that came across was, I believe the statistic that you had quoted was 39% bankruptcies in the United States. You were kind enough to go into some of the industries or sectors that you thought will be impacted more than others. But if you were to break down, and the viewer didn't quite give all the different break points, but if you were to break down between small business owners, Main Street USA versus a middle market company versus a large national or publicly traded, how would you allocate, within those three quadrants, or if you want to redefine it a little bit in your terms, how would you break that out based on business or company size?
So that's a very good question. Unfortunately, the US data for bankruptcy are not as extensive as I would like them to be. So it's quite difficult to have exact figures on bankruptcies by size of companies. But considering the nature of the shock, we already know that small SMEs are particularly exposed to the effect of the COVID-19 crisis. So they will probably be the driver of these trends of increased bankruptcy. And well, there are more SMEs anyways than big corporations. So it's normal to see them leading the pack in terms of increased bankruptcy. They have less leeway, and that's also why they're more vulnerable. That's also why they will be driving the trend. Just to give you an example, with the energy sector that I developed already, the oil majors, ExxonMobil, Chevron, are not at risks. They have to cut investment spending. They have to cut production right now, and it's very damaging for their business. But they are big enough to survive this crisis. The companies that will go into bankruptcies are the smaller players that were involved in the upstream sector, and other actors in the value chains that do not have the means and resources of big companies. With that being said, we will see big companies fail in the next few months, and we're already seeing that some big companies are filing for bankruptcy. Just last week, the bankruptcy filing of Neiman Marcus was a big example of a big retailer going into bankruptcy, and we will probably see more of these very big bankruptcies in the future. So we'll see a lot more of all types of bankruptcies, mostly for small and medium-sized companies. But you should expect also bigger companies to be affected by this trend.
Ruben, I appreciate that. At this point, there's no further questions on the economic update. So we appreciate your insight as always. It was very informative. Thank you very much. If I may now turn it over to Ryan Morse from COFAS. Ryan will present for roughly 10 to 15 minutes on the increasing importance of trade credit insurance, also known as insurance around your accounts receivable, one of the largest assets on most businesses' balance sheets. So without further ado, Ryan, the floor is yours.
Thank you, Bill, and thank you, Ruben. Good afternoon, everyone. I hope you all are doing well, and thank you for attending our webinar today. During my portion of today's presentation, as Bill mentioned, I'll be discussing the key reasons our over 50,000 customers choose to partner with us, everything that goes into our debtor risk assessments and credit limit decisions, and the flexibility of our programs, which are tailored to meet each of our clients' individual needs. Our global credit insurance and information offer is enabled by our extensive global network. We cover more than 200 countries, providing credit information assessments on over 100 million companies globally. We possess over 600 risk experts across the globe and make 13,000 credit limit decisions per day. And our A2 rating for Moody's was just reconfirmed recently. As Bill mentioned, accounts receivable is oftentimes the lifeblood of an organization, typically making up 30 to 40% of their entire assets. Partnering with COFOS is like partnering with the strongest credit department in the world with a checkbook. We protect against losses from non-payment, whether it's a slow pay or bankruptcy situation. We help better address cash flow needs by managing late payments. We help manage commercial, political risks that may be beyond our control, like this COVID-19 situation is a perfect example. We help manage risk by leveraging our proprietary information on the over 100 million companies worldwide that we monitor. We help to extend credit to new buyers and more credit to existing buyers, and we help free up capital currently held in reserve. Many of my clients also use credit insurance to improve their financing terms with their lenders, get lower interest rates, and let them borrow more working capital to fund key business initiatives that they have. On this slide, another main reason that companies will use credit insurance is as a sales growth tool. Now, the next year, this is typically not why most companies are going to use credit insurance to be more aggressive with going after marginal customers. But the last several years since the last recession, this is what most of my customers would use credit insurance for as a sales growth tool. So a new company would come to them and want to purchase $500,000 of product. It's a new buyer, so with credit insurance, it allows them to immediately get them approved, typically for $500,000. They turn that 4 times during the year. You can see in the calculation that would give them a return on investment of 385%. And that's what most customers use us for the last several years as the sales growth tool. Now, obviously, with the COVID-19 situation, it's more of a protection mode to monitor, have our underwriters monitor the financial stability of their key suppliers and key customers so that if one of their customers starts to go downhill, they can be notified instantly and make more prudent credit decisions that will enhance their credit department. What goes into our debtor risk assessments and our credit limit decisions and why it is crucial, especially now with all the volatility in the market, to partner with us. If you look at this funnel, these are all the things that go into our underwriting decisions. And if you look at the next page, this is what really sets us aside from regular traditional information providers. Every single credit department in the world, uses positive payment history to make credit decisions. They purchase information from companies like D&B, Experian, but purchasing product and information product lines from COFOS really sets them apart because of all these additional inputs that goes into our information. So in that blue box category where you see the underwriting ratings, the global notification of overdue accounts and claims data, the global data collection, global payment performance, all of that stuff are additional inputs that go into the information that we're providing our over 50,000 customers worldwide so that they can make more prudent business decisions. Now, obviously this year things are different, but typically our programs are extremely customizable and tailored to fit the needs of each of our customers. I'll have some customers that tell me they're only interested in insuring companies that owe them over $50,000. And anybody less than $50,000, they're not worried about. So we can structure a program that only insures companies that owe them over $50,000. I have some customers exact opposite. They're worried about all their smaller companies going bankrupt. So we can offer blanket coverage that insures all those smaller companies. Some of my clients only want to insure their top 10 or 20 largest accounts. We can do that as well. We can add large deductibles to the programs to reduce premiums. It's really up to the individual customer of kind of what they're looking for and how they want to best use credit insurance for their business. When you have a program with us in place, how easy is it to manage? Our online customer portal is extremely easy to use. You can instantly request new coverage, modify existing coverage, have all of your customers' financial stability monitored in real time, also sent to your inbox anytime there's a change. You can file and manage claims. We also have a mobile app that a lot of my clients who are billion-dollar corporations, they have sales agents all around the world trying to source new business. They give them access to our mobile app so they can get instant credit decisions approved when they're in business meetings all around the world with our easy-to-use mobile app. Okay, so this last page is testimonials. We can kind of take a look at that. If you want to connect with me on LinkedIn to see more, you can. I just wanted to take a few more minutes of your time kind of to discuss expectations right now during the COVID-19 pandemic. Think of getting credit insurance right now as, you know, your kids are downstairs playing with matches and the house could catch on fire. We're still writing policies. But with the significant increase in claims we expect globally, it really depends on the individual customers that you're looking to insure. We may not be able to provide the necessary coverages due to how much coverage we already have approved for other customers that have had credit insurance for years and have been paying premiums. However, one of the best product lines we have right now, if you might be in the travel industry where you have companies, you're selling to airline industries, you're selling to restaurants, you're selling to companies that we may not be able to get the insurance for right now. Our underwriters will actually monitor the financial stability of your key suppliers and key customers for only $45 each for a US customer for the entire year. And that fee goes up to $140 for a company in a D-rated country. So if you guys want to go after this webinar or anytime to our website, which is cofas-usa.com, you can click on economic studies and it will give you an in-depth analysis of every country and sector in the world. Ruben had mentioned that they're redoing all those now after the first quarter. So those will be updated in the next couple weeks. But that's it for me. So I appreciate your guys' time, and I will open the floor in case anybody has any questions specific to our credit information and credit insurance product and the presentation that I gave.
Ryan, thank you so much. This is Bill from Palmer & Kay again. A question that came in is if you had a few additional tips for CFOs, controllers, or business owners out there, if you had a few tips as they consider their trade credit, be it ideally with COFAS, but if it was with one of your competitors, what are some recommendations you would have? Maybe some exclusions to look out for, or some key language that they should try to have endorsed. I know you mentioned that these policies are customizable, but what are a couple of examples, some pitfalls that they don't want to fall into?
Yeah, so my number one recommendation right now, if they're with one of our competitors, is to look at our debtor risk assessment plus monitoring information package. The minimum package is only $1,500 for the year. And if they have credit insurance with another carrier, if you have a lot of claims, doesn't matter who you're with, the rates are going to increase dramatically over the next several years the more claims you file. So what my clients do is, the ones who might be with a competitor for credit insurance, they'll use COFAS's risk information because a lot of the times it's different than Euler's or another credit insurance carrier, because we have different financial information, different risk underwriters. So having the most and the best information to make those credit decisions, that would be my key recommendation right now, which will reduce the chances of filing claims. The other thing is you can use that DRA plus monitoring for key suppliers in supply chain. I've had several of my clients have a key supplier go bankrupt on them out of the blue, and they're traveling, they're not traveling now, but before the crisis, they were traveling all over the world to try to find another key supplier to be able to produce the raw materials they needed to get their product out the door. So having COFAS be able to monitor the financial stability of key suppliers and customers would be my top recommendation. The other recommendation that I would recommend is making sure, if you have a credit insurance policy in place, that you have what's called a delayed effective cancellation rider on the policy. So what that does is, if you get a cancellation notice, now I can't speak to my competitors' policies, but I can speak to ours. If you have a delayed effective cancellation rider, if you get a cancellation, that rider doesn't take effect for another 30 days. So within that 30 days, you can work with your sales agent. If you hopefully have a good sales agent that you work with, that can negotiate internally with the underwriters to find out what new information can be gathered to appeal that decision to get that coverage reinstated. So that's one of the key riders. Also, if material is being custom made, if it's custom made material, you want to make sure that you have a special goods rider on your policy to make sure that it covers any sort of stuff that can't be resold. That's can't be resold to anybody else. But those are a few of my key recommendations right now. And if I think of any, I can send them after the presentation, Bill, to you, and you can.
Ryan, thank you. Another question that came across, you mentioned earlier, just a minute ago, having a key supplier. When COFAS is underwriting a particular insured, if they've got 2 or 3 large clients and not a great spread, how much more of a load, if you will, on the rate or the premium would you place if they have a very high concentration? Or do you not look at that? You're just underwriting their buyers.
That's a great question. And again, it depends on the individual creditworthiness of that buyer. So, if that buyer's Walmart, Lowe's, or Home Depot right now, and they have a 90% concentration, well, that would not, significantly impact the price as much as it would if that 80 to 90% concentration was with a company that had a risk grade of a 2, 3, or 4. So we risk grade every company from a 0 to a 10. 0 is an insolvent company, a 10 is the best. So depending upon the creditworthiness of those exposures, and what I would be willing to offer everybody is, if anybody wants to send, you, Bill, you can forward to me maybe the top 3 to 5 of those large accounts. I'd be more than happy to look up what our debtor risk assessment score is on those accounts and see if we're providing insurance at this time on those accounts.
Thank you. Ryan, I appreciate your insight. We have no further questions from the audience at this point. Again, on behalf of Palmer & Kay and COFAS, we appreciate you all for taking the time to share with us on some economic insights and the impact from COVID. And appreciate COFAS and their attention on this subject. So we appreciate it. Everyone, please be safe, and we'll talk with you soon.